Millions of Canadians are either in retirement today or are planning to retire within the next 10 years. But here's the thing, retirement in Canada isn't just about hitting a certain age, it's about making sure you have enough income from multiple different sources to actually live the lifestyle that you want. In this video, I'm going to break down the main income streams that you can rely on in retirement, from government programs like CPP, OAS, and GIS to your own savings like RRSPs, TFSAs, pensions, and other investments. And by the end of this video, you'll have a much clearer picture of how these pieces fit together and how you can plan for a comfortable retirement. Let's start with one of the biggest pillars of retirement income in Canada, the Canada Pension Plan, also known as CPP. CPP is a contributory program, which means you pay into it while you are still working, and then you receive payments back during retirement. Anyone who has worked in Canada and contributed to the plan is therefore by definition eligible to receive its benefits during retirement. Both employees and employers contribute to CPP, and if you're self-employed, you unfortunately pay both portions. In 2015, the CPP contribution rate is 5.95% of your earnings, up to the yearly maximum pensionable earnings, called YMPE for short, which is $68,500. That means the maximum you contribute is about $3,800, and your employer will match that amount. And again, if you're self-employed, you're looking at roughly double paying both at just over $7,600. Now, how much could you actually receive during retirement? Well, the maximum monthly amount at age 65 in 2025 is about $1,400 per month. But here's the catch. Very few people actually get that maximum. What you receive depends on two things. Number one, how much you contributed each year to that YMPE cap. And number two, how many years you contributed, usually between the ages of 18 and 65. Here's an example to illustrate this. Let's say you worked from age 22 to 65, earning $55,000 per year on average during your career. Well, since the YMPE in 2025 is $68,500, you are contributing close to the maximum each year, but not quite at that ceiling. Over 43 years though, your contributions would still be considered quite strong in this case, but wouldn't achieve that maximum amount. So in this case, you might expect to receive somewhere around $1,050 to $1,150 per month at age 65 instead of that maximum $1,400. Timing also matters in regards to how much CPP you'll receive, as you can start CPP as early as age 60, but your payments are reduced by 0.6% for every month before age 65, which is a 36% reduction if you start collecting it right at age 60. On the flip side, if you delay until age 70, you can get an increase of 0.7% per month, or 42% more than if you took it out at 65 and on. Ultimately though, this is why planning your retirement income sources is so important. If you're healthy and potentially expecting to live into your 80s or 90s, delaying CPP can add up to tens of thousands of extra dollars in your pocket over your retirement. The other major government benefit is called Old Age Security, or OAS for short. And unlike CPP, you don't have to contribute directly to this program to receive benefits. Instead, it's funded through general tax revenues, and eligibility is based on how long you've lived in Canada. To qualify, you must be at least 65 years old, and you need to have lived in Canada for at least 10 years after the age of 18 to get a partial pension. To get the full amount, you need 40 years of residence after age 18. So if you've lived fewer than 40 years in Canada, you'll get 1/40th of the full pension for each year of residence. As of 2025, the maximum OAS benefit is about $713 per month if you're between ages 65 and 74. And it increases slightly to around $784 per month once you hit 75. That's roughly $8,500 to $9,400 per year at the maximum. So let's say you immigrated to Canada at age 30 and retire at 65. 65. Well, that's 35 years of residence. And since the full OAS requires 40 years, you'd receive 35/40ths of that maximum. So instead of $713 a month at 65, you'd receive about $624 per month. Now here's where it can get a little tricky. The OAS clawback, officially called the OAS recovery tax. If your annual income is above a certain threshold during retirement, OAS benefits start to get reduced. In 2025, that threshold is roughly $90,000, meaning for every dollar of income that you earn above that amount, your OAS is reduced by 15 cents. Let's look at a quick example for this. If your net income is $100,000, that's $10,000 over the 90,000 threshold. So multiply that by 15% and we're looking at $1,500. That $1,500 is the amount your OAS would get reduced by for the year. What this means is that if your income is high enough, in the ballpark of $150,000 and up, your entire OAS benefit can be clawed back to zero. Now, for lower income seniors, there's another major program called the Guaranteed Income Supplement, or GIS. This is an additional monthly payment that's stacked on top of old age security we just looked over, but only if your income falls below a certain level. Unlike CPP and OAS, the GIS is not taxable and is specifically targeted at Canadians who need it the most, where to qualify, you must already be receiving OAS, and then your eligibility will depend on your annual income, as well as your spouse's income if you're married or common law. The GIS is income tested every year based on your previous year's tax return, and the amount you receive decreases as your income rises. So for a single senior, the maximum GIS in 2025 is just over $1,065 per month. If your income is essentially zero, not counting OAS, and if your annual income is below about $22,000, you will qualify for at least some GIS. For couples, the thresholds are slightly higher and depend on whether your spouse also receives OAS or GIS. For example, if both of you receive OAS, the combined income cutoff is around $28,000. So let's say you're a single retiree with no private savings and your only income is OAS at $713 per month, or about $8,550 per year. Well, because your income is below $22,000, you'd qualify for nearly the maximum GIS amount, which would add about $12,700 per year to your income. The GIS is essentially a poverty prevention program for seniors above 65, ensuring that even if you didn't save much or weren't able to work long enough to build up CPP contributions, you won't be left with only old age security. Moving on from government retirement sources, let's talk about personal retirement savings tools, starting with the most well-known, the RRSP. The RRSP is a government registered account where your contributions are tax deductible in the year that you make them. That means if you earn $80,000 a year and contribute $10,000 to your RRSP, you're only taxed as if you earned $70,000. That being said, you can carry forward your contributions if you know you'll be making more money in a future year. From there, the investment within your RRSP, whether it's stocks, bonds, exchange traded funds, or even GICs, grow tax deferred. But once you withdraw them in retirement, those withdrawals are taxed as regular income. Here's something about the RRSP that quite a few people don't realize. By December 31st of the year you turn 71, your RRSP must be converted to an RRIF, a registered retirement income fund. And with a RRIF, you can't just leave the money invested indefinitely. The government requires you to take out a minimum annual withdrawal, which increases as you get older. For example, at age 71, the minimum withdrawal is 5.28% of the account balance, and then by age 80 it rises to 6.82%, and by 90 it's 11.92%, and it keeps climbing each year. So say you had $500,000 in your RRIF at age 71, you'd be required to withdraw at least about $26,400 that year, whether you need it or not. And that withdrawal counts as taxable income, which could push you into a higher tax bracket or even reduce government benefits like OAS. The upside is that your money can stay invested inside the RRIF, and only the required withdrawal portion has to come out each year. But it's still important to plan ahead, because large balances later in life can result in very large withdrawals and higher taxes. Then we have a newer account being the TFSA, which is arguably the most flexible retirement savings tool available to Canadians, where unlike the RRSP, you don't get a tax deduction when you contribute to the account, but any growth inside the account, capital gains, dividends, or interest, is completely tax-free. And here's the kicker as well: when you withdraw money, those withdrawals also are not considered taxable income. This is incredibly powerful in retirement for two main reasons. First off, it's a tax-free income source. If you've built up a large TFSA over time, you can withdraw thousands of dollars per year completely tax-free. This can supplement CPP and OAS without pushing you into higher tax brackets. And the second benefit is that it can preserve other benefits as well, because TFSA withdrawals don't count as income. They won't affect your eligibility for income tested benefits like GIS or trigger an OAS clawback. As of 2025, the annual contribution limit is $7,000 and the total lifetime limit is $102,000 if you were 18 or older when the TFSA was introduced in 2009. But here's an important detail: if you withdraw from your TFSA, you can get that contribution room back the following calendar year, which gives you added flexibility to use it both as a retirement savings vehicle and as a rainy day fund. Next, although not exactly designed as a retirement account, the FHSA, being the first home savings account, can still play an indirect role in your long-term financial picture. The FHSA is built for first-time homebuyers, as it combines the best features of an RRSP and a TFSA. You get a tax deduction on your contributions, just like the RRSP, and then the tax-free withdrawals when the money is used to buy your first home, like a TFSA. But here's where the FHSA can tie into retirement potentially. If you never end up purchasing a home with the money inside your FHSA, it will not go to waste. You can transfer the balance directly into your RRSP or later into your RRIF without any penalty. And it won't affect your existing RRSP contribution room either. That means the FHSA essentially gives you an extra bucket of registered saving space that you can later repurpose for retirement. So even though most people think of the FHSA as a shorter term housing account, because it is, well, in practice, it can also serve as a long-term backup retirement plan. Moving on, if you're lucky enough to have a workplace pension, that's another big piece of the retirement income puzzle. Employer pensions are becoming less common in Canada, but for those who do have them, they can absolutely form one of the most stable and predictable income streams during retirement. So here are two main types of pensions. Number one, we have the defined benefit plans. These are the gold standard of pensions. A DB plan guarantees you a specific monthly payment in retirement, and the amount is typically calculated using a formula based on your salary and years of service. For example, a common formula might be 2% of your average salary over your best 5 years, times the number of years that you worked at the company. So if you worked, say, 30 years with an average salary of $70,000 in your 5 best years, that could give you around $42,000 per year in guaranteed retirement income. It's essentially like having a private version of CPP that pays you for life, regardless of market conditions. The second type is known as the defined contribution plan, where with a DC plan, there's no guaranteed payout. Instead, you and your employer will contribute set amounts each year into an account that's invested in the market. What you end up with in retirement depends on investment returns. The upside with this is that you have control over how the money is invested, and the account is portable if you switch jobs. The downside though is that you bear the investment risk. In retirement, DC plans are usually converted into an RRIF, or an annuity to provide income. Overall though, employer pensions can very well provide a reliable foundation for retirement income. And in some cases, they can even be indexed to inflation, meaning your payments rise each year to keep up with the cost of living. That's an incredibly valuable feature because it protects your purchasing power as prices go up over time. Of course, many Canadians also invest outside of registered investment accounts. Non-registered investment accounts don't give you tax sheltering, but they provide flexibility and can supplement your investments if you've maxed out your tax-sheltered investment account contribution limits. This could include a portfolio of dividend-paying stocks, exchange-traded funds, bonds, or even real estate. Rental properties, for example, can provide steady cash flow in retirement, along with the potential for capital appreciation, though this very well comes with a much more active management throughout your career. The trade-off is that there is no tax deferral, so you'll pay tax on investment income annually. Finally, let's not forget business owners. If you've built a company, your business can be one of the most powerful retirement assets that you own. Unlike an RRSP or a TFSA, which have contribution limits, a successful business doesn't have a ceiling on the value it can create. There's really two main ways a business can serve as a retirement income source. The first one being selling the business outright. Many entrepreneurs plan to eventually sell their business and use the proceeds as their retirement fund. If you've built a valuable company, this can result in a large lump sum that can be invested to provide retirement income. And in Canada, there's also the lifetime capital gains exemption, which currently allows you to shelter up to $1 million worth of capital gains from tax when selling shares of a qualified small business corporation. This can be a massive tax break that makes selling a business one of the most efficient retirement strategies available. The second option would be keeping the business and then drawing income from it if possible. Some owners prefer to keep their company running into retirement, either by hiring managers to handle the day-to-day or scaling back their involvement. And in this case, the business's retained earnings and investment portfolio could continue to generate income. You might pay yourself dividends, a salary, or a mix of both, depending on your tax strategy. Ultimately though, with this, the right approach depends on your business structure, succession planning, and how much involvement you really want once you're retired. What's important though is to plan very early in this case if you are an entrepreneur, as setting up proper corporate structures, planning around taxes, and thinking about succession can make the difference between a smooth transition or leaving a lot of money on the table, as for many entrepreneurs, their business isn't just an income source, it is their single largest asset. So building it with retirement in mind is one of the smartest moves that you can make. Alright, now knowing all of these sources of income is great, but the real key is planning ahead to make sure they'll cover your lifestyle. Here are a few tips to keep in mind. Number one, start early. The sooner you start investing, the more time your money has to grow and compound. Even small contributions do compound over decades. Number two, aim for at least 15% of your income invested. If you can consistently save and invest that amount, you're setting yourself up for success. Three, diversify your income sources if possible. Don't rely on just one stream. Mix in government benefits, pensions, RRSPs, TFSAs, and potentially other investments as well if possible. Four, know your expenses very well. If you expect to need $5,000 a month during retirement and you're using, say, the 4% withdrawal rule, you'll want a portfolio of around $1.5 million of value. For someone starting at age 30, for example, with nothing, that works out to about $600 per month invested until age 65. Next, plan for taxes. Remember, RRSP and pension withdrawals are fully taxable. Be strategic in how you withdraw to stay in lower tax brackets. So that's the retirement income landscape in Canada. Between CPP, OAS, GIS, pensions, personal savings, and investments, you have multiple levers that you can pull to create a stable income during retirement. If you found this video helpful, please consider leaving it a like. And if you want to learn more about investing on your own in the stock market, I'd recommend you check out my 100% free to watch Skillshare course about stock market investing. It has over 3,000 students, and once again, completely free for you to watch on a 1-month free trial. And if you want a simple way to start investing today, check out Wealthsimple as well. I've got an affiliate link down below that gives you a nice little sign up bonus. Thanks a lot for watching, and I'll see you in the next one.